Hey everyone, happy Friday, July 26, 2024, year of our Lord. I'm Phil Hodgen and welcome to the Hodgen Law PC International Tax Lunch. We do this almost every Friday, last Friday of the month at noon Pacific time. Adjust it slightly for when we have a collision with tax filing deadlines or holidays. You can listen in online live just like you are right now, courtesy of Cal CPA, or at some point later, we'll get these things launched up to YouTube and you can watch them at your leisure. Tell your friends. This month is Real Estate Holding Structures Fixing Problems. So it's episode 4 in a series of 6, sort of like an overview of foreign investment in U.S. real property. And now we come to the situation of what happens if somebody acquired real estate, a non-resident, in a structure that has tax problems. And almost invariably, in my experience, has tax problems is just mispronunciation of the words exposed to estate tax if I fall over dead. So we're trying, and that's what I'm going to talk about mostly today. So today is an hour worth of that. Just so you know, Rachel will be in the chat collecting chat questions so I can deal with them later. But also at the end of this session, we'll let the Cal CPA Zoom link go and we will launch a separate Zoom link that you can ask live Q&A afterwards, and I'll be on Zoom until you run out of questions or I run out of energy, whatever comes first. So we'll do that. So let's begin by making the slides move. So here we are, where we are in the session. And just so you see, next month, we're going to be talking about income taxation of these holding structures. And because I find that's not often talked about, it's not terribly sexy, but it's intensely interesting if you have to prepare an income tax return for a non-resident investor to report rental income, blah, blah, blah. And so you need to know how the bolts connect on that. And then finally, in a couple of months, we'll be wrapping up with a case study where I'm going to walk you through, in this case, California, because that's where I am, what happens when a non-resident sells a home that's always been used for personal purposes, never rented out. Just the mechanics of handling a transaction like that, including the tax stuff. Our table of contents for the day, you'll see an introduction. Then we're going to talk about restructuring into a foreign corporate structure. Then I'm going to talk about restructuring into a trust structure, because those are the two methods that you can use to eliminate an estate tax problem. And then part 4, the conclusion. So let's start with at the beginning. As noted, there are 2 types of holding structures that eliminate estate tax. And we talked about that in the previous episode when we talked about estate tax. One is the foreign corporate structure. So the non-resident alien individual owns shares of a foreign corporation. The foreign corporation might own the U.S. real estate directly, might have a wholly owned C Corp subsidiary, might have an LLC, who knows? The key to protection there from estate tax is the fact that the non-resident alien individual, if he or she falls over dead and attains the notable status of decedent, what's in the gross estate? Well, stock of a foreign corporation. Stock of a foreign corporation is located outside the United States. Therefore, the gross estate for U.S. estate tax purposes contains nothing, therefore no estate tax. Yay. Similarly, irrevocable non-grantor trust. Real estate held by a non-grantor trust, what happens if the settlor, the person who set it up, dies? Well, as long as the settlor does not have a retained interest, technical phrase, section 2036 through 2038 of the code, as long as the settlor does not have a retained interest in the trust assets, the settlor dies and there's nothing in the gross estate of the settlor. Similarly, beneficiaries of the trust, if they fall over dead, what do they have? Typically a lifetime interest in the enjoyment of the trust assets in the discretion of the trustee. So they fall over dead. What do they own? Nothing, because they're dead. So no estate tax in that case. So these are the two that we're going to aim at. And I'm going to ignore restructuring purely for income tax performance enhancement. We're going to see a little bit of that next month when I talk about income tax, but just so you know what typically that means is you're trying to get away when you have a corporate structure, you're trying to get away from that because you realize, oh, I've got a C corporation that owns real estate that's going to appreciate, and I'm renting it out. So I've got rental income and I'm paying tax on the rental income at the corporate tax rate, 21% federal, whatever, for state income tax. And now I've got a bunch of cash from the rental income and I want to pass it upstream to the shareholder. So the shareholder can go on vacation and buy yachts and stuff like that. And that's going to be a dividend, default taxation at 30% by withholding. And I don't like that. So I'm trying to get away from that. And so usually that's what I see in terms of the income tax rearrangement to get away from that problem. But again, just to keep this within an hour, I'm going to ignore the income tax stuff because quite frankly, if it's 95% estate tax problems and 5% income tax problems, it's about right in terms of what I see day to day. So Scylla and Charybdis. Here you go. The Straits of Messina between Sicily and Italy. On the mainland side, there's a little town called Scylla. And on the Sicily side, well, there's Charybdis. And Scylla and Charybdis, this is a Greek myth that goes back to Homer. It's a narrow strait that you'd go through, and if you sailed too close to one side, the rocks would get you, and if you sailed too close to the other side, the whirlpool would get you, because this being a little narrow, the land comes quite close together. The currents are kind of strong. And so this is the ancient Greek mythology of between a rock and a hard place kind of thing. And we are in this little boat, and as we're sailing towards the sunset, we are looking to avoid two tax problems. Gift tax, if you screw things up and accidentally make a taxable gift, or capital gain tax, if as you're restructuring, you create a gain recognition event that takes all of your unrealized appreciation and makes it immediately taxable, which is a catastrophe because, basically when you're just moving stuff around on paper like this, the same owner owns it before and after all of the restructuring. And it's like taking a $20 bill out of your right-hand pocket and putting in your left pocket and having to pay tax for the privilege of doing that. Not really optimal, is it? So this is what we're going to be looking at. You're going to see these two tax problems in play as we move along. Now, why do these things exist? Well, as long as everything is static, tax rules do nothing to you. An event must occur, either an event that looks like a quote sale or exchange, close quotes, or an event that looks like a gift. And then once that event happens, the Internal Revenue Code tells you what the tax picture is going to look like for it. So there will always be an ownership change, by definition, because we're trying to get ownership of this real estate asset out of whatever it is now into something else. So we're going to have some kind of disposition, which is going to be an ownership change. And sometimes several. You might have, you'll see an example in a little bit. Put the property into a corporation, and then put the corporate stock into another corporation. So you go from direct ownership into a parent-sub relationship. There's two steps there. And there might be more if you have hideously complicated stuff. But you will have at least one disposition. So you'll have at least one moment in time where you either have a capital gain tax problem or you have a gift tax problem. Or it's going to be a taxable gift, which is Section 2501, the gift tax rules. And a gift is something where you relinquish ownership of an asset and you get nothing in return, as compared to a sale or exchange where you relinquish ownership of an asset and you get something back in return. So it's going to be one or the other. And everything is going to be taxable until proven otherwise. So the gain realized by section 1001A, realized being a technical term, is recognized, meaning included in your gross income, by section 1001C. Or a gift transfer, if you make a gift, it's going to be taxable unless you find an exclusion, like the small gift under 17, 18,000, whatever it is now, or you use some of the unified credit, unless you can find a way around the problem. And our game today is to find a way around the problem. Restructuring. Okay. In a restructuring to a foreign corporation, the only kind of problem you're going to have is an exchange, because you're always going to be giving away something and receiving something in return. And typically that something in return is going to be stock, right? If you really just think of the normal 1031 or anything like that, where what you get back is like kind, or it's the approved kind of stuff you get back plus boot. Same thing in an exchange. If you receive something that doesn't qualify for non-recognition, like boot, you're going to get taxed. But there will never be a gift tax problem because you're always getting something back. In a gift situation, when you're going to a trust, you'll always have a gift at one point in the transaction, and you might have some preliminary exchanges, gain recognition events that you need to work around preliminary to that gift event, gift into the trust. So these are the that's what you're looking for as you're choosing your restructure target and you're going to put together a plan. The workarounds. Fortunately, the place that you have to look for the workarounds, there are two specific places to go. Number one, non-recognition as a general principle doesn't work for non-residents who own U.S. real estate unless you can find one of the approved ways in the code or the regulations. And if you look in regulation section 1.897-6T, like temporary, if you find something that works in there, you're golden. If you can't find something that works in there, you've got gain recognition. For gift tax, we're going to rely on section 2501A2 that says when a non-resident, non-citizen of the United States makes a gift of intangible personal property, in air quotes, that is not within the definition of a taxable gift. And that's the one we're going to rely on. So gift of real estate, I have a grant deed, I transfer by grant deed my ownership interest in real estate to my kid. That's a taxable gift for a non-resident, non-citizen. I put the real estate into a corporation, give the shares of the corporation to my kid. That's not a taxable event, and we'll talk more about that later. All right, let's go into the restructuring into foreign corporate ownership, because that's the big problem. Frankly, that's where the complexities are. And Section 897 is kind of a shit show of complexity. And so I wanted to at least show you how the whole system is structured. I mean, how to find your way through the code and the regulations to a non-recognition rule if it works for you. So let's start with an example, and this is what I'm going to use all the way through for the corporate restructuring. Let's say you start with, I have direct ownership of U.S. real estate, and I've decided for prudent reasons that I want a foreign corporation domestic subsidiary structure to own this because I want to eliminate estate tax. So this is our objective, and say, let's go. Now let's make this tax-free, no gain recognition on the appreciated value of the real estate that I'm putting into this structure. So this is what you think is going to happen. So step one says, oh, this is a Section 351 transaction, right? When I contribute an asset and receive stock in return, non-recognition for the shareholder, non-recognition for the corporation that receives the asset. Basis is carryover basis. Everything is fine. Default Section 351. This is what your brain first goes to. Similarly, you say, All right, step two, I'm going to take the shares of this domestic corporation and I'm going to make a capital contribution of this stock into another corporation, a parent corporation, Section 351 again, right? And this again is your default assumption. This should work just fine. And at the end, you have your non-resident individual who owns a stock of a foreign corporation. So fall over dead, there's no estate tax. Foreign corporation has a domestic subsidiary owns a stock. The real estate, hey presto, what's not to like? Well, here's what's not to like. Section 897E says, not so fast, buddy. If you are a non-resident, none of the non-recognition rules anywhere in the Internal Revenue Code will work for you unless you can find an explicit blessing either in Section 897, the code, or in the regulations published under Section 897. So default turn off 351, it ain't working for you. And there's something else that's even worse. They say, even if it works for you at the very end, Section 7874 says that whenever a foreign corporation acquires all of the assets of a domestic corporation, guess what? We're going to recharacterize the foreign corporation as really being a domestic corporation. So you're just fine. You've got your real estate in this parent subsidiary relationship, but it's a domestic parent and domestic subsidiary. And now if you fall over dead, guess what you have in your gross estate? You have stock of the domestic, quotes, domestic, I should say, parent company, and you've got estate tax problems. So let's now going to start again at the beginning, non-recognition rules, just so we are all in the same direction. Remember that we've got a disposition and the normal calculation of gain is amount realized, what the buyer gave you minus your basis, and that's your gain or loss realized. Section 1001C says you're going to recognize all of that gain in your gross income. And if you look at, all over the place, but Section 61A3 definition of gross income says, except as otherwise provided in this title, gross income includes gain or loss from, I forget how they phrase it, transactions in property or something like that. And so what we're going to look at is for somewhere in Title 26, an exclusion of this thing from gross income, just like we have an exclusion that says, if you receive death benefits on the life insurance, that's not included in your gross income. Or we're going to have a non-recognition rule that says, even though you have gross income, here is a trump card and you're not going to have gross income. Section 351 is one of them. 1031 is another one. There's a bunch, right? Contributions of corporate to partnerships and the like, but let's not go through the whole list. So that's the rule for everybody, and non-residents have the extra overlay that they have to think about Section 897. And in Section 897E is where it basically says you ain't got no non-recognition rules unless you can find an exception. And so that's what we're going for. And the non-recognition rules of Section 897, there are two categories. One is when you have real estate already owned by a foreign corporation and the foreign corporation makes a distribution to its shareholders. We're going to ignore that one today. And the second one is what we're going to talk about, which is dispositions of U.S. real property interests by foreign individuals and foreign corporations. So going back to my example, non-resident human owns house, wants to put house in corporation. That's a disposition of the house. What are we going to do about it? And the rules that you're going to be looking for are the temporary regulation, the -6T that I told you about. Unfortunately, what happened is they published these temporary regulations in 1988 and then went, oh, actually, when we actually go to final, we're going to make these changes because we didn't get it right in 1988. So these series of 4 notices that I've listed here are amendments to their intentions to take the temporary regulations to final, which they've never done. So what this means is you have to look first at the temporary regulations, then you have to go and see if any of these notices have changed anything in there. And the combination of the temporary regulation plus the cumulative effect of these four notices is what you're playing with to figure out if you get non-recognition or not. There's paperwork requirements giving notice to the government, and frankly, it's pretty simple, and I'm not going to worry about it. You send a letter saying, hey, Commissioner, we did the thing, and you're fine. So the 897E, there are two parts of it. The first one is 897E1, and this one says there's non-recognition will work for you in the jargony phrase if you give up a U.S. real property interest and you receive in return in the exchange another real property interest. And the classic example I'll show you for that is you take U.S. property that you own, you put it in a domestic corporation, and you get domestic corporation stock back. That will work. The second way that you get non-recognition rules for transfers of U.S. real estate are whatever the regulations say. So 897E2 says, well, whatever the commissioner writes in the regulations, you can have non-recognition for those transactions as well. And so we're going to dive into 6T in a little bit. So here you are. This is the game that we're playing. You're trying to fit your dispositions when you've got an exchange and you're transferring real estate from one place to another, and it's an exchange, not a gift. You're trying to make it either look like a US RPI for US RPI exchange, or you're going to make it look like a foreign for foreign exchange, which is the set of exceptions that you will find and discuss in the regulations in a little bit. So that's where we are. I mean, to a certain degree, it's kind of good. You know how a lot of tax problems, you say, well, I think I solved it, but have I read all billion pages of the code and the regs? Because the government has a propensity to litter exceptions all over the place in unexpected locations, and you never quite know for sure whether you've covered the thing. At least here, you know where to look for the answers. So let's talk about US RPI for US RPI exchanges. United States real property interest definition for coming in a second. Here is the technical requirement for this non-recognition disposition exception. You have to have three things. You have a transferred United States real property interest exchanged for another US real property interest. That's the first question. The second one is immediately after the exchange, what you have in your hand would be subject to US income taxation if you sold it at that moment. So this way, the government is assured whatever gain is there, well, I'm going to get the tax on that capital gain somehow under Section 897. And the third one is the paperwork requirements. So remember, US RPI for US RPI, immediately subject to taxation, because the government doesn't want you to do a transfer where on day one, capital gain is taxable, day two, capital gain is not taxable. And the third one is paperwork, because tax is always paperwork. A US RPI is defined in Section 897. There are only two kinds. One is the dirt and the buildings, expanded in definition. And, sometimes personal property, bulldozer, lawnmower, stuff like that can be treated as real estate, but that's just the government doing government things and definitions. But think of dirt and buildings is one type of US real property interest, and the other type of real property interest is stock in a domestic corporation that owns a lot of US real estate. It's a balance sheet, so more than 50% of the balance sheet, which is then a United States real property holding company. And so this stock of that type of corporation is itself treated as if it's functionally equivalent to real estate. So let's go back to our exchange here. We're going from A to B. How do we get there? And remember, step one, by default, it failed because Section 897 and CE said you don't get non-recognition until you prove that you can get it under 897 or the regs. And we made it work. because remember, we just looked at section 1.897-6TA1, the US RPI for US RPI. I gave a deed, my ownership in dirt, and I received a stock certificate, my ownership of a United States real property holding company. If I, the non-resident shareholder, sell that stock now, 897A says I have to pay capital gain tax on it. All good. So that works. So we've got the first step from individual into a domestic corporation. Now let's get the real estate in from that, because if the individual dies at this moment, the estate tax is still going to apply because it has a U.S. asset, stock, and a domestic corporation. So let's go to the next one. Again, by default, this is going to be, we're thinking it's the 351, but we can't use the US RPI for US RPI exception because stock of a domestic corporation is a United States real property interest, but stock of a foreign corporation is not a United States real property interest. So if I give my shares of domestic corporation as a capital contribution to foreign corp and in return receive shares of foreign corp stock as part of that restructuring, I have not received a U.S. real property interest, and therefore the exception that we talked about in 897, 1.897-6, capital T, little a, little capital Roman numeral 1, don't work. So we have to now look for another method to get a different non-recognition methodology to get us from step 1 into step 2 to where we want to be. So what I've given you right here is the high-level overview of non-recognition exceptions. What does a US RPI for US RPI non-recognition transaction look like? And here's an example. Now let's go into the second category of non-recognition transactions in the regulation, which are the foreign to foreign exchanges. So you're making a transaction where at the end, you're not getting back a US real property interest, but yet the government says, yeah, you can do non-recognition because I know I'm going to get my tax eventually anyway. Now, there are 5 different non-recognitions that are approved for corporate restructuring. 3 of them are in the regulations, and 2 of them are from Notice 2006-46. So now you see the effect, the cumulative effect of you not only have to look at the regulations, but you have to look at these damn notices as well to make sure that you've covered all the exceptions. You got it, all the rest of the stuff that you have to do, you still have to do because the government wants to know stuff. But you don't have to receive a US real property interest in exchange. You can receive something else. So here are the 5 bullet points, and I've put the one that they're not in sequence according to the regs, but I put the one that we're going to use at the top of the list. Foreign to foreign reorgs under 368A1B and 351 transactions. Yay. Okay. So this is the one that we're going to work. So now we see that if we can fit ourselves within little Romanet 3 in the regs there, we can get non-recognition for transferring the stock of the domestic corporation to the foreign parent in return for stock of the foreign parent. The other ones are various iterations of Section 368 orgs, publicly traded or not. And then the very bottom one is an esoteric one that, frankly, I don't quite understand, but on the other hand, I've never seen it anyway. So that top one is the one that at least you're going to see. I've done transactions with top one and the second one down, like 368 and an F reorg. Plenty of times you move for good business reasons. You have a foreign parent in the Caymans and you want to have a foreign parent in Bahamas, right? F reorg, boom, 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 done. Notice given, you're set. So here is what you have to do for a Section 351 transaction. So you have your transaction that's appropriate, that's the top one, And then you see the bottom highlight there, before and after, the same proportionate ownership exists, so whoever were the shareholders of the domestic corporation is the identical proportionate shareholder of the parent afterwards. So there's been no economic change at all. It's just it's a paperwork restructuring, and the same ultimate beneficial owners exist before and after. And that's what we're going to have always, right? So 100% ownership to 100% ownership, or 50-50 to 50-50 or something like that. So this is what we would use in this situation. So you can see here that the foreign to foreign change is now, you start at the bottom. I have a 351 transaction I want to do. It doesn't work because of section 897E. But 897E gives me a section exception, so it does work. And here we go, this one right here. So now I've given you an example of the foreign to foreign idea. And you notice that it was fairly limited, and you'll have to fit yourself within the constraints of one of those 5 types of corporate reorganizations in order to get non-recognition. However, now we come to the sad trombones part of the equation. Section 7874. I believe this is the very last or the next to last code section in the entire Title 26. So talk about hiding places far, far away where you don't really see them. We think we've gone to step 1, step 2, and we've achieved non-recognition. This is fabulous, but have we achieved estate tax protection? And the answer is, unfortunately, no. And this one describes section 7874B. 7874 basically was created to attack US multinationals that would reincorporate overseas, so that instead of being taxable on their worldwide income, they could be taxable only on their US source income, and the rest of the world income would be out of bounds because it would be earned by a foreign corporation. So that's what it is, and it's insanely complicated because it's aimed at publicly traded multinationals. And here we are, little ants on the field, trying to make sure we don't get stomped on, and unfortunately we do get stomped on. But basically what it says is, if you meet these requirements, your foreign corporation is treated as if it's a domestic corporation for the entire Internal Revenue Code. And as you'll see, we meet those qualifications, and therefore what we have is a foreign corporation that also is classified as a domestic corporation for US tax purposes. And it's just like a dual citizenship human being. You've got a British passport and a US passport. Well, for US tax purposes, they don't care that you have a British passport. All that matters is you have the US passport. You're taxable here. So 787B calls it an inverted corporation. And an inverted corporation is one that acquires all of the, or substantially all of the assets of a domestic corporation. And acquiring the stock of a domestic corporation indirectly acquires its assets. And so I'm giving you a pathway here. It says inverted corporation is a surrogate for foreign corporation with a certain threshold of ownership. And the threshold of ownership is that after the acquisition, 80% or more of the foreign corporation is owned by the shareholders of the domestic corporation. Well, in our example, it's 100% before and 100% after, so we're cooked. The foreign corporation acquired indirectly the assets of the domestic corporation because it got all the stock. And before and after the acquisition, the domestic shareholders are the foreign shareholders. And so Dunn 787B says this is an inverted corporation, and therefore it's a domestic corporation. And so as a result, the technical lesson learned here is that non-recognition rules can very frequently be used to take you from a position of owned by a human to owned by a foreign parent, foreign subsidiary structure. No, foreign parent, domestic subsidiary. There you go. So you can get non-recognition, so you win the battles, but you're going to lose the war in almost every case that I can think about, because Section 7874 is going to reclassify that foreign parent as a domestic corporation, and therefore you have not eliminated the U.S. estate tax risk. And there you go. I mean, I wish I knew another way. And if somebody on the line knows other ways to look at it and how you can avoid 7874, my hat is off to you. There may be some esoteric ways to do it. And in fact, I can think of one, but I'm not going to blurt it out because I've got the statute of limitations running, he said. So, but there we go. So I would say, if you have a client who wants to restructure into a foreign parent domestic subsidiary structure, the odds are pretty low that you're going to find a way around it. So that's going to be my suggestion to you, which means I think by default the safer way is going to be the more complicated way, which is trusts. Which leads us into our next discussion. I've got 10 more minutes on the unadjusted clock, not counting for the delay while we had to switch over because things were broken. So let's see if we can hit it pretty quickly and get you out within the hour. I hope. Restructuring into a trust. So think about your Music of the Spheres Platonic ideal trust structure. You have an irrevocable non-grantor trust, domestic or subsidiary, that owns U.S. real estate. It might own U.S. real estate directly in the name of the trust. It might own an LLC that owns a real estate, whatever. But you have a trust at the top level. You have it set up so that the person who created the trust, the settlor in trust jargon, created the trust and put money into the trust by a gift, and then the real estate was purchased with the money, has no retained interest, means no indirect control. Retained interests could be control or economic interests under Section 2036 through 2038. The beneficiaries don't have a general power of appointment over the trust assets, so they have no exposure to estate tax when they die. That's the ideal. So what we're looking at here is, how can we get from a situation where a human being owns United States real property in his or her own name as an individual, non-resident, and wants to put it into a trust of some kind without any tax problems. And what we're going to be talking about is gift tax here. So here is the gift tax rule. I've given you the regs here. There's a weird mishmash of rules that you have to put together until you get the sort of combined effect. But the idea here for gift tax purposes is that a non-resident, non-citizen of the United States is taxable on gifts of direct ownership in U.S. real property, your name on title here, or gifts of tangible personal property, meaning something you can touch that's not real estate. And that tangible personal property must be located in the United States. Those are the two things. Other than that, all other gifts are not taxable gifts. And specifically, gifts of intangible personal property are not subject to tax when the giver is a non-resident, non-citizen of the United States. So this is the exploit that we're going to be using. All right, let's go back to law school, first semester, property course. Here we go. What kind of property is there in the US system? Well, there are two kinds. There's real property, which is the dirt, the things attached to dirt. And we're not going to think about any of the extra doodads that Section 897 also defines as a US real property interest, because we're out of Section 897. 897 is an income tax problem. 2501 is a gift tax problem, different universes. And also remember that when you're reading the code in the gift tax sections, you see the word real property. You don't see the words real property interest. United States real property interest is a magic word for Section 897 only. It doesn't apply to gift tax. So we're back, basically, we're back to normal rules of what is property as defined for US system, legal and tax. So real property is one, and everything that is not real property is personal property. That's how it works. And there are two kinds of personal property: tangible personal property, physical items that you can touch, and intangible personal property, which is all kinds of personal property after you take away intangible personal property. So you can see it's like a rule and then a remainder, a rule and then a remainder kind of thing. But the idea for intangible personal property, you have an asset that you know exists and you know you own, but you can't touch it. A copyright. How can you touch a copyright? How can you touch a share of corporate stock? You can't. You can touch a piece of paper that says that you own a share of corporate stock, but you can't touch the share itself. So this is intangible personal property. So let's talk about gifts of ownership interests in an entity that owns United States real property. Remember, this is what we had before in the situation with well, I should say it's very similar, except look at the end target. Instead of a corporate ownership with a foreign parent domestic subsidiary, we have a non-grantor trust. And it has no ownership, right? Because the trust isn't owned by anybody. It has beneficiaries, and the beneficiaries are whoever they are, not important to us. So step one is you say, I'm going to use, well, I have an exchange, don't I? I own this real estate and I'm going to give it to a corporation. This is Section 351, and I'm going to get stock in return. This is a US RPI for US RPI exchange, tax-free, non-recognition, carryover basis, blah, 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 blah. Step two, I'm going to give the shares of the domestic corporation to the non-grantor trust. This shares of the domestic corporation are intangible personal property. As you saw, Section 2501A2 says gifts of intangible personal property simply aren't part of the bucket that constitutes a taxable gift. The end. So even though you have a transfer of a domestic asset, shares of a domestic corporation, you do not have a taxable gift. By contrast, if this person at that moment before the gift into the trust fell over dead, the inclusion in the gross estate would include the shares of the domestic corporation. So there's this little anomaly, this little discontinuity in the definition of what's taxable for estate tax purposes and what's taxable for gift tax purposes that you're going to be running straight through. You can also see that if you got somebody who's that close to death and you've got to do something, quickly whip it into an entity, and then that person gives the shares to a daughter or somebody younger, boom, gift works, person dies, the asset is out of the estate. So the point is that we got an exchange, step one, and we know how to deal with the exchange with the United States real property interest for United States real property interest under 897. And then step two, we had a non-gift gift that got the assets into the trust. And so that's what it is. Now, Corporation, do you have to use that? Yeah, I've done that. So for instance, I've had a gentleman, non-resident, and he had a bunch of real estate in the United States, rental properties and whatnot. His son came here to go to school, never went back, became a US resident, set up a domestic trust, give all the shares of the domestic corporation that father owned to the trust, make an S election. Hey presto. Or give the shares directly to son, make an S election. Hey presto. If you want the trust to be able to have own shares of an S corporation, it has to be an electing small business trust. You just make sure that works. So, but how do you know, I gave you an example of a corporation. What about an LLC? Wouldn't that be easier? Well, yeah, it would be. And here's the definition of an LLC membership interest from Delaware. You know, by statute, it says it's personal property. And we know for a fact that it's personal property that's, you can't touch it. So it's intangible personal property. So gift of a Delaware LLC membership interest is not a taxable gift. And we know that the gift of an LLC membership interest to someone is a gift of the membership interest and not a gift of the underlying assets, even if it's a single member LLC, because there's a tax court case called Suzanne Pierre versus Commissioner that says so. So you can use an LLC, you can use a partnership. Think of all the family limited partnership cases over the last decades where a gift of a limited partnership interest was qualified as a gift of the partnership interest, not the underlying assets. Partnership interest is intangible personal property. So there you go. It's a really interesting thing. If you look at the annual thing that the government publishes and says, we, the IRS, will give you a ruling on this sort of thing, but we will never rule on whether something is tangible or intangible personal property or personal property, real property. So good luck with that. So you have to work your way through the law, and I gave you Delaware, to your own satisfaction to prove that this entity interest is intangible personal property. Doesn't matter whether it's domestic or foreign entity, it'll all work. So the real problem with the trust structures is not so much the transfers to get you there, it's making sure that you set up and operate the trust correctly. And setting up and operating the trust correctly is code word for it's complicated and expensive. And that's where the client usually says, oh, can't I use a corporation? And you're going to have to go back and say, hey, no, actually, that's not going to work so well. So I brought you through the pain factory of the foreign corporation restructuring to show you the limitations of that and show you how, unless otherwise proven, you have to assume that it's a dead end in order to bring you to this trust alternative to help you persuade your client that that's the way to go. So here we go to the conclusion. Summary, you know, what have we learned today? Restructuring to a foreign corporation, the real problem is Section 7874. Restructuring to a trust structure, the real problem is that you have to pay a metric ton of money to somebody like me to do a trust correctly. And then you have to pay a metric ton of money to somebody who is a trustee and trust administrator to do the accounting and all the hoo-ha and the tax returns for the trust, which are more complicated than corporate stuff. So that's it. My apologies. We got almost done on time. My apologies for the break in the middle for fun and excitement. I know Robert had some excitement and, you know, sweating bullets there for a few minutes before Brenda jumped in. So we're all done. Here is my contact information. Be sure to send me an email. If you're not, because you're watching this thing later, you're not on the mailing list to get updates, go to internationaltaxlaw.com, put yourself on the mailing list so you get updates and copies of this, that, and the other. With that, I'm going to wrap it up. First things first, next month is, as I said, income taxation of U.S. real estate investments by non-residents. Second one is pimping the mailing list, which I already did. Third one is we will have the Zoom session immediately following. So I'm going to log out of this and log into the other Zoom chat. So you can ask questions either, you know, live or in the chat window, and we'll go until we're all out of steam. Anyway, thanks. Thanks for putting up with the little delay in the middle, and see you next time. Bye.